I'm Bob Henderson. I'm the Nomad Dad, and I'm here to talk to you about how the investment industry has changed over my lifetime. So you may know that I essentially had two careers. Primarily, I was in the investment business, life insurance investment business for 39 years. I was also in radio and television for 25 plus years, some before I went into the investment business, but most concurrently. So I will kind of fuse the two as these episodes continue. But as far as the investment business is concerned, I started in the mid-'70s, and we'd just come off a giant bear market. In 1973, 74, it was a pretty bad recession. It was due to the Arab oil embargo, and oil prices shot through the roof. You could get gasoline for 25 cents a gallon prior to that, and then it was well over $1. So we had a lot of inflation in the 70s, and a big part of it was oil. I started out primarily with training in the life insurance business, which gave me a wonderful idea as to how to do needs-based selling. And, find out what somebody needs and, fill the bill, fulfill the needs. I think that's largely what Andrew's Nomad Capitalist does, by the way. I started in the mid and late 70s and then more and more gravitated toward the investment business from the 80s onward. And when I started there, you could obviously buy stocks and bonds, individual stocks and bonds, and commissions were greatly lowered by the time I started. A new type of investment came into play in the mid-'70s, options. So primarily all kinds of options, but primarily calls, covered calls or naked calls, and puts. So if you buy a put, it's a way of insuring your portfolio on the downside. All kinds of different strategies you can use. And so this was something good to have, gave you a hedge in the portfolio, and sometimes with covered calls, a way to generate additional cash. And we had a great year in 1975 after horrific lows. I mean, the Dow lost over 50% over that 73, 74 period. So it was individual stocks and bonds, unit investment trusts, primarily with bonds in them, and mutual funds. And you'll never believe this, but for small investments in mutual funds, the sales charge was as high as 8.5%. So you put in $10,000, it was $850 sales charge. That's a lot. That has changed dramatically. So stocks, bonds, unit investment trusts, and mutual funds. And this was a big part of my business throughout most of the 39 or so years. Toward the end of my career, exchange-traded funds, or ETFs, came into play. I like the idea of the ETFs. So maybe it's an oil and gas ETF. So they'll buy individual stocks in that sector, or maybe it's aerospace and defense. So they'll be buying the Lockheed Martins and the Boeings and that sort of thing in that ETF. This probably makes more sense than buying those sorts of mutual funds. And they trade like stocks. So you trade, if you're going to buy or sell, you get the price at that moment. Whereas mutual funds, you get the price at the end of the day. So it's easier to get in and out. They're less expensive to buy. And by the way, on those mutual funds, the 8.5%, that did go away. It gradually got reduced and reduced and reduced. And in the middle and then later years of my career, a lot of my clients had quite a bit of money in the mutual funds, either because they had invested that much or they did so well that maybe they were worth over $500,000 or $1 million in that particular fund family. So we could put new money in for next to nothing, maybe literally 0% or as high as 1.5% or so. So the big change, I think, is the exchange-traded funds, or the ETFs. There are expenses to them other than just the commission charge. You need to look at those expenses on an annual basis. The other thing that I think has changed, and I've got an opinion, we did commissions, but today it's largely on a fee basis. So if you have $1 million and it's a 1% fee, well, there's $10,000 a year you pay in fees. I think there's a place for both, to be quite frank. If you're just buying ETFs, probably fees are going to make more sense. But I would be very careful as to what percentage I pay my advisor on an annual basis in terms of fees. I've seen some that I think are a little bit too high. They are not deductible, by the way, those fees. And this could hurt particularly in an IRA or, a qualified plan of some sort where, you're going to be costing yourself eventually retirement income. I don't want to get too deep into the weeds, but I would look very carefully at the fees. I would want to make sure that they are tiered so that at one level it's this, but the more you have, the actual overall percentage of the assets under management is lower and lower. I'm not saying there's a right way and a wrong way, and I'm not giving investment advice here because it depends. Every client is different. You don't want to use a cookie cutter approach. But if somebody's not investing new money and they just have, some kind of a portfolio of mutual funds where there's some annual fees already charged, by the way, maybe 0.25% a year, I don't think that adding fees on top of that is necessarily the way to go. Now, maybe in your case, but it's something I think you need to take a look at. Again, I am not giving investment advice. As they say, your mileage may vary. Your situation, the investment advisor is to obviously do what's right for the customer. And I always like to say, well, the better you, the customer, does, the better I do, because primarily in mutual funds, if it was 0.25%, if your fund went up substantially, well, then I get 0.25% on a higher amount of money. And so we all win. And to me, that's what we need to be doing, all winning. So look closely at the fees. There may be a valid case for them. In many cases, I think there is. But it's not just every case. And I don't like any industry treating everybody the same way. Let's not take a cookie cutter approach. A couple other things. I've talked to some former associates who says they all say the business is no fun anymore, largely because the government and the firms are so worried about the next Bernie Madoff. That was 15 years ago. And I don't think a lot of the regulations that are being promulgated are going to stop the next Bernie Madoff, for that matter. It's just burdensome regulation. I'm all for regulation in the securities business, has to be done, but they have to be sensible. And it got to the point where, and that's why I probably left the business a little earlier than I could have, because they were becoming too onerous. And the people that I see, they just have so much paperwork to do to justify every little thing. It's no fun. That's what they're telling me. Here's one other thing. I wish that the industry would allow their representatives to more aggressively promote the ownership of gold and silver. I'm going to give you an example. I started in 1975. The Dow, the high that year was, I believe, 924. Gold had just been legalized at the end of 1974 by President Ford. It was $42 an ounce. And I remember working at a radio station in 1975, and we had a solid gold weekend. We were giving away an ounce of gold every hour over the weekend, $42. Pretty nice prize. Had you bought it, you're looking at, I don't know, 1,900, 2,000 today. That's almost 47-fold as I do my math. The Dow in that same period is up about, been hovering around 33,000 or so lately. That's a 35 times increase. However, you would have gotten dividend income from the Dow, which you haven't gotten from gold, and there's storage fees for the gold. I get all that. But the point is, gold held its own pretty nicely over that period of time, and it's a wonderful diversification tool. I would never put all my money in that, but I'd have a piece. They say 5 to 10%. Again, your situation's different. Don't overdo it, but have some. It's a nice insurance policy. Now, here's a fun fact. I told you about the radio station that I was on. I was one of the jocks, and we gave away gold on the solid gold weekend, $42 an ounce. Usually we gave away tickets to an amusement park, nice gift, or tickets to a concert. So I remember in 1975, you could go, say, to a Rod Stewart or an Aerosmith concert. I remember that it cost $7 in 1975 to go see Rod Stewart. $8 if you bought the tickets at the door. That was a nice prize. But that $42 an ounce for those people that held on to that gold, and now they have, close to a 50 times gain. Wow, what a prize that was. What a prize that was. And I find that, as I say, kind of a fun fact. But again, I wish that in the securities industry, the reps would be counseled and encouraged to bring up the topic of gold and silver. I remember I used to recommend to my clients junk silver, and they still, at the end of my career, they kind of chuckle and say, Bob, you know, we've moved twice, but we always took those heavy buckets of that junk silver with us, and it's proven to be a good investment. No, we didn't overdo it, didn't spend a lot of money, but it was a hedge. It was an insurance policy. These are my thoughts on the investment business today versus when I started. I'm the Nomad Dad, Bob Henderson.